Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Cara Murphy of Kestra Investment Management writing, we are modestly overweight equities with lower exposure to mega caps in favour of mid-cap, a tilt towards non-US and a focus on earnings growth. Cara joins us now for more. Cara, good morning.
Good morning.
Let's get to that last slide. Earnings growth. Where are you seeing it? Where's it coming from?
So I think we definitely had a pause heading into second quarter, and that's sort of what we're going to be chewing through over the next couple of weeks as we make our way through earnings season. But what is so important and what is usually important in earnings season is getting the view of the second half. And I think what we're finding is that CEOs are coming in a little bit bolder about what the second half looks like. They're able to sort of take that slower growth in the second quarter, but then see a real reacceleration into the second half of the year.
Where are they getting clarity on policy from?
I don't think they are.
I'm not seeing it. Lisa's not seeing it. Are you seeing it?
I think what they're able to do, and this is where time is all of our friend, right? When tariffs were first introduced in early April, it was this huge change and people didn't really understand even what the implications were for their supply chains. Over the last couple of months, many CEOs have been able to sharpen their pencils, understand where those implications are, sometimes diversify their supply chains so that they're less sort of beholden to, let's say, China, where, that's sort of been ground zero for tariffs, and also be able to forecast different scenarios. So again, this doesn't say that policy isn't an impact. I think policy uncertainty is still a really big challenge, but being able to have that time to work through it really makes it much easier to be able to manage through.
Is the air getting very rare for some of these stocks? And John was asking for the totality of the morning, saying, not good enough, not good enough. And that seems to be the read-through from bank stocks. Is that a sort of wider spread phenomenon throughout the stock market?
So when we came into earlier this year, one of the main risks that we saw were high valuations in a very concentrated market. With the rebound that we've had more recently, we still have those same exact risks. And so that's really a big reason why we're leaning a little bit more into mid-caps, a little bit more into non-US. So yes, I think that's a challenge, but it's a challenge for certain names. And then you mentioned financials. I think that's a really interesting area where these names got some really nice lift recently. So I think some of the maybe lackluster reaction to the earnings is more a reflection of what the stocks have done recently. And I think importantly, as we look through those bank earnings, what we see is pretty decent underlying economic growth. And I think, again, that augurs well for second half earnings growth in general.
It feels very volatile. There's been a lot of volatility on a headline level. When you actually look at the MOVE index, which is implied volatility in treasury yields, it's pretty low. When you take a look at the average VIX, it's come down pretty significantly. Do you just sort of sit on your hands, decide what you like, buy it, go on vacation?
Well, I like to describe the first half of the year as the Rip Van Winkle market, right? If you had gone to bed on January 1st, woken up at the end of June, you'd be like, I did a great job. I feel really good.
I wish I had.
Right? Don't we all wish?
I've been on vacation
many levels.
But carry on.
Right, but the challenge is that we all lived through that. The good news is that experience helped us sort of live through what we're going through now. And I think over the weekend, we saw this new introduction of tariffs, and the market just didn't react, right? The market has reacted less and less with every new tariff announcement because, and this is important, because the assumption is that the Trump administration is not going to accept a recession in exchange for its trade agenda. If that breaks, then I think we have a very different market. But as long as that holds, the market's going to be like, okay, you can tinker at you as you will, but we're not going to face a recession, so all is good.
How are you justifying the tilt to non-US at the moment?
So this has been a challenge for US investors for a very long time. And we talk with a lot of investors who are, frustrated with owning anything outside the S&P 500. And over the years, you've seen, again, higher and higher concentration in US stocks around the world, higher and higher valuation differentials between those. But but it's been largely justified because of stronger growth in the U.S. I think as we're moving from a very unipolar free trade world to a multipolar world where maybe U.S. is a little bit less dominant, I think we start to see capital flows outside of the U.S. And then on top of that, you have maybe a little bit of a narrowing of the differential in growth rates, a little bit of a narrowing of that valuation differential.
What is the European growth story that I can get excited about? What is it?
So it's a little bit better than what it was before, and that's what's important. So there is a lot of infrastructure spending that's happening, and so it's just that incremental growth. It's not necessarily that it's going to take off going forward, but it's priced for a slower growth environment than what I think we see in the next couple of years.
The growth story is fewer holidays. That's what we're learning
for us.
for us, sure. Yeah, but in France, right, the idea that you're going to take 2 holidays out. I just wonder, what this sort of debt management and sort of when debt is too much discussion, whether that's really going to come into play with bond vigilantes. It seemed to be picking on Germany, even though Germany's debt to GDP ratio is really good. It's not as though they're particularly overly indebted, and yet you've seen yields in the long end climb there too.
I think if there's anybody who needs the finger pointed at that has a debt problem, it's the U.S. And as I think about one of the largest challenges that the U.S. faces, and a really intractable problem, is the amount of debt that we have. And let's be clear, it is Republicans and Democrats who have contributed to this. This is not a political issue. This is an American issue. We like to spend money, and so far the debt markets have given us a pass, right? For many, many years, we had really, really low interest rates. Now that's changed, and that's why the equation really has to change. But I don't think we're going to tackle it anytime soon.
Cara, it's good to see you. Thanks for dropping by.
Thank you.
Cara Murphy there of Kestra Investment Management. Pierre Ferragu of New Street Research joins us now with a buy rating on Nvidia and a price target of 200. Pierre joins us now. Pierre, welcome to the program. It's a change of policy. What kind of change does it make? What kind of difference does it make for this company?
Well, John, is it really a change of policy? When you look at the last couple of years, Nvidia has been able to ship chips in China on and off as like the export rules varied over time. So like earlier this year, we had like a very strict like tightening of the rule that created a potential shortfall for Nvidia of like $8-10 billion, over what was left of the year, and now there is an easing again of these of these restrictions. We had a similar situation last year and the year before last. So I would say this back and forth, you shouldn't read too much into it. I think the reality is that you have a situation with 3 major metrics. One is making sure we protect like the US leadership in AI. The second one is making sure we don't completely cut off the relationship with China because, as Brandon mentioned, China has very important elements into the AI race, like the rare earth materials. And the third one is that, of course, the US government, the US administration is very careful to protect the interest of US companies. And so this situation always creates a back and forth. It's good sometimes to tighten the rules to slow down like the progress of China. But at the same time, doing too much of that favors China is developing their own supply chain. And it's good to maintain the leadership of US companies globally. So it's good, as Jensen said, that they keep selling in China, and you have like the right balance to find over time. And that would be the way I look at it.
Pierre, how much is Nvidia's fate really dependent on the close relationship that Jensen Huang has with President Trump and the fact that, move over Tim Cook, he's the new tech ambassador for the United States?
Well, you could almost invert the question, how important is it for President Trump to make sure that he has like a strong ally in Jensen, like the number one, or let's say one of the number ones, tech leaders. And we know that the relationship with Elon Musk is a bit sour these days. So I think it's very important to maintain strong relationships. And yes, I think there is no real situation where the US administration wouldn't have a careful ear to the concerns of Jensen, because the success of Nvidia is what matters the most to the US maintaining their leadership in AI development. And I think that's what I read in the trip to China of Jensen and his comments and his ability, to speak before the White House on commitments from the White House tells you a lot about how much bargaining power he has in the conversation.
Quite a lot, apparently, Pierre. Quite a lot based on the experience of the last few days. Pierre Ferragu there of New Street Research. Pierre, thank you, sir. Devin Ryan of Citizens downgrading Goldman Sachs to market perform ahead of the results, writing, quote, "The bar is now much higher for another leg up." Devin joins us now for more. Devin, we've come a long way. We've had a big rally for most of these banks coming into this earnings season. What do you make of what you've heard so far?
Yeah, hey, Jonathan. Good quarter. We thought it would be a good quarter. We were quite a bit above the street, but they still beat our numbers. And so what we're seeing is tariffs were actually pretty good for trading. And so we'll have to see now that kind of the tariff volatility has died down a little bit, what the back half of the year looks like for trading. But then on the other side, investment banking activity is really re-accelerating. Remember in April, we were questioning whether this is a pause or a break for investment banking. Right now, it looked like it was clearly a pause, and now all that activity that was kind of put on the back burner is now moving to the front burner. So we're seeing a pretty substantial re-acceleration. Announced M&A volumes are tracking up 20% year over year, even with losing a couple months. Number of IPOs in the U.S. are up 80%. So we feel really good. Goldman, we put a buy on it at $200 back in 2020. So now it's $700. The bar's higher, and that was really what the call was.
Do you see enough in the numbers this morning, at least, to question the downgrade, Devin, or are you sticking with the thesis?
Yeah, we're sticking with the thesis. Listen, it's a great company, and our thesis was, they're taking market share, and people don't really realize it. And then also they're growing their asset management business, particularly in alternatives, and people don't appreciate how much assets they're raising. And so I felt like we had a differentiated call, and now we've become more consensus. So we're just looking for opportunities where we still have differentiated calls. But listen, you had a great quarter, and I actually think the outlook, again, trading is going to be a little bit of a question mark into the back half of the year because the tariff volatility did help. But Goldman Sachs and Morgan Stanley, too, they're gaining market share. So you have the market backdrop, which volatility helps. Then on top of that, both firms are actually taking market share in trading. Goldman's really leaning in on their prime brokerage business. So we feel really good about the tone of the business. We want to reevaluate on the stocks here and consolidate some of these gains we've seen.
We've heard a pretty steady story across all the bank earnings about how steady the consumer is, how businesses are gaining confidence, and there's a feeling that everything is chugging along with a greater degree of certainty than on April 2nd. I'm just wondering if this is a broader economic kind of read-through, as John's been asking all morning, or if this is something that really indicates the banks have been much more cautious with who they lend to, the creditworthiness of all of their clients.
Yeah, I think what we're seeing and what we're hearing is that, there's obviously always tail risks here. And I think people are cautious to make sure that there's a lot of macro events that are occurring. Tariffs are still uncertainty there. There's geopolitical risks. And so I think there's obviously a sense of, cautiousness just to be careful that you're not getting yourself in trouble. But overall, the trends that I think banks are seeing right now and that we're talking to both investors and CEOs about is that things are good out there. The consumer is in still a very good spot. The low end of the consumer is being more affected by inflation, and there's maybe a little more challenges there. But more broadly, the consumer is in a great spot. And then companies, as you see in investment banking activity, are leaning back in. So they're going back on offense. M&A volumes are picking up. Companies are feeling good about raising capital. Their stock prices are at all-time highs. So I think there's a really good sense of kind of optimism in the market right now from both corporates and consumers, and that's what I think we're going to hear from virtually all banks through earnings season here.
There's really a question about whether this is a pivot point where some of these banks that have been treated as though they're utilities for the past 10 years can become more growthy, especially if they start to get deregulated to the point where they can compete more aggressively with private asset managers. Do you see that as a likelihood this year?
Well, if you listen to JP Morgan's call yesterday, a lot of questions on fintech, a lot of questions on stablecoins and tokenization. So I think the conversation is evolving a little bit. Banks are still, I think, obviously, steadier types of business models, and they're not going to take a lot of risk. But this world of kind of less regulation, I think, is starting to creep in, and I think is going to be a tailwind for banks over the next couple of years. And then on top of that, I think another catalyst here is consolidation. You're starting to see a little bit of bank mergers. It's going to be in the kind of the small, mid-sized banks, but I think that's going to be very valuation enhancing. And I'd look to the back half of this year to start to see some of that. And I think that will be a catalyst for the broader group, something that we really haven't seen over the past 4 years.
So, Devin, just drill down on some of that. As you mentioned earlier, some of these ideas became very consensus, Goldman being one of them, and it certainly performed. If you were looking for something non-consensus, something a little bit different in this sector, maybe the broader industry group, what would you look for?
Yeah, so we're kind of, some of the large cap names I think are pretty well owned right now. It's kind of the index plays. So we're looking at some of our mid-cap coverage, so a company like Stifel, which kind of looks like Morgan Stanley in terms of wealth management and institutional exposure, but much more reasonable valuation at kind of 11 times our exit 2026 earnings level, but still get some of those really good exposures. Then they also have pretty good leverage to bank M&A with their KBW business. So kind of that theme that we just talked about. So that would be one. A small cap advisory boutique called Perella Weinberg is a name we really like. So we want to be selective here just after these really big runs. And then I'd also, regional banks, as I just mentioned, with bank consolidation and deregulation, I think that can have a bigger impact on their business models as well. So broadly, that is a kind of an index play.
Hey, Devin, appreciate it. Thanks for giving us some time. Busy morning for you, I know. Devin Ryan there at Citizens. Joining us around the table, a potential candidate, the former World Bank President, David Malpass. David, good morning.
Good morning, John.
Would you like to be considered?
Of course. So it's a huge job and really important to the Trump changeover that's going on in the world, saving the country. But it means a lot of change at the Fed. I think they've been making many mistakes, and we can enumerate them and correct them, and that will mean more growth, and especially more growth in median income. If the Fed were allowing more small business growth, there'd be more jobs that are new jobs for people across the country, not just in urban areas.
Well, let's get into some of the details. Walk us through a couple of the examples where you think they've made mistakes and the remedies for them. How you'd correct course.
I didn't like QE. Think about QE, that the Fed in its wisdom is going to go buy bonds. So how did that work out? They've lost $1 trillion. They'll lose much more than that before they're done with the losses on the bonds. In addition to that, remember, they've paid out in interest constantly since 2009. They've paid $1.3 trillion of taxpayer money to banks and to money market funds. That's the source of funding that they have to buy the bonds. So this has been the worst hedge trade in history. So that's a big mistake. It's also led to inflation because the Fed really allowed a merger of fiscal policy and central banking or monetary policy by buying bonds as the government was really jacking up the deficit.
Well, you're out of the running already, because I have to say, isn't that exactly what the president would like to see?
What would he like?
President Donald Trump would very much like to see monetary policy and fiscal policy very well aligned.
No, I think he wants to see them both improved and is already doing that. The reconciliation bill improves fiscal policy, and the separation, what we need is lower interest rates, and you can't do that if you've got the Fed carrying the load of all this fiscal deficit that Congress is generating.
So in the near term, as a candidate yourself, what do you do as a potential new Fed chair to the composition of the Fed and the approach that you think right-sizes it?
I think really important is people to see the flaws of the inflation targeting model. I've been writing about this literally since the 80s, that if you target inflation as your goal, it's backward looking and it doesn't comprehend all of the prices within the economy. It's just a flawed indicator, but that is the basis of how the Fed sets interest rates. So one of the things is you switch and you say the dual mandate is to have price stability. That's very different from CPI inflation, which wavers around and gives you false signals. That's what's happening right now. So you need lower interest rates because of the strength of the U.S. economy. I think that's something that I understand a lot from working all over the world and in Wall Street, in financial markets, that the U.S. is this giant power and people want to invest in the U.S. even at lower interest rates.
Okay, this is a fascinating argument. It's one that President Trump has talked about, the idea that it should be almost a credit rating of the United States that backs what our interest rates should be. So like a Microsoft or an Apple, the borrowing cost should be very low. People are pegging it to inflation and they're pegging it to growth. I'm just wondering, the market doesn't see it that way, right? We're not there yet. So at this point, how potentially perilous is this discussion at a time where the market associates lower interest rates with faster inflation and frankly higher borrowing costs for the United States?
The market's inbred with the Fed, and so as long as the Fed is the sheriff of the land, the market is going to say, oh, we operate on that model. But as you change to a model that makes more sense, one that's based on the growth and credit of the U.S. has something to say about what the interest rates are that we should pay, that can be a smooth, safe transition. But it has to be explained. Markets adjust. Think of what's going on tariffs now. There was a giant panic that didn't materialize. The change in the Fed system is as big as the change that we need in the trading system, and it will work better for growth and especially better for the forgotten man. The median income has been doing very poorly over these maybe 20 years, and so if you have a system that's very focused on defending the dollar as the global reserve currency, and then people flooding into dollars, that's actually supportive of markets.
Seconds left. Have you spoken to the president about the role?
I don't want to talk about the process. What I really want people to focus on is the models that need to be changed.
Okay.
We can have a much faster growth economy with different Fed models, and it can be done with the confidence that is absolutely necessary.
We can have a longer conversation about that next time, sir. Appreciate your time.
Thanks.
And best of luck. The former World Bank president, David Malpass.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.